Hello there, it's Shabundal, and today we shall be discussing this topic called Macroeconomic Scenario of the European Union. As we discussed before as well, that even though the course name is European Corporate Finance, but it's very important for the finance people to understand some of the macroeconomic dynamics, because if you don't understand the interplay of some macroeconomic indicators such as the interest rates, the GDP forecast, the inflation rate, the exchange rate movements, then it can be harder for you to understand the real, the genesis of the corporate finance, and including the fiscal policy of the state. So the monetary and the fiscal policy are the two important macroeconomic, principles or the tools which every student of finance should be having some understanding of, because otherwise you will not be able to, you can do very good calculations without knowing the macroeconomic dynamics. The problem is that when it comes to interpretation and when it comes to the forecast and see the larger picture, then your knowledge will be incomplete as a student of finance if you have not studied macroeconomics. Okay, so let's go further. In the current topic, I have three core objectives. The first one is that we shall study and understand some of the key macroeconomic characteristics which the EU is undergoing at the moment. Even though that course name is Europe, it's the key word is Europe, but I'm explaining it in the context of European Union, and it's not very different from, when I say Europe and European Union in terms of the macroeconomic indicators. Of course, the biggest exclusion is the United Kingdom, which is part of Europe geographically, politically, but it's not part of the EU. But except that country, most of the rest of the European countries, despite the fact that they're not a member of the European Union, things are fairly, similar, if not same. So therefore, in this topic, I shall be using the phrase Europe and EU as synonyms. The second objective is to analyze the macroeconomic realities descriptively through discourse, through narration of the European Union through the theoretical lenses, because some of the theoretical paradigms are very much applicable these days. Then we shall be studying the current and the potential consequences of the macroeconomic realities, which can have its impact in the near future. Let's see some of the worrying signs which the EU is experiencing at the moment. And I collect them with the red background of the page. And some of the negative signs, as you can see in this slide, is that there is an economic slowdown that started quite significantly in the second half of the last year, 2022. There was exorbitant inflation, 40% the energy prices inflation in the autumn of 2020. And the reasoning behind it, it's not difficult to understand, because first of all, the EU, like any other country in the world, it was grappling with the COVID-19. And then, as if that was not enough, then came this war between Russia and Ukraine. And this has totally shattered the supply chain of the essential products. There's a massive inflation the countries are going through. Okay. The country rate of inflation can vary, but overall, if I take EU as one entity, EU has been experiencing massive inflation. And you can see that there's 40% increase in the energy prices only in the second half of the 22. And on top of that, the economic growth is slowing down, and there is a projection for stagflation. I will come back to this phrase stagflation in the next slide. The second worrying factor is that even though the interest rates are rising, and even though initially you can blame COVID-19 for the rise of interest rates, because the banks were very conservative in terms of giving credit to the banks. And on top of that, this war between Russia and Ukraine has played a very big havoc in this respect. Uh, there is a further expectation of interest rate rising in the EU. And the problem is that when the interest rate go up, this can, this can discourage the investors because the value of their investment can go down significantly. Whenever there is a rise in the interest rates, the investors are the one who suffer quite a lot. As you can see in this spreadsheet, I just created some hypothetical example. And the title of this file is Inverse Relationship Between Interest Rate and Value of Investment. So imagine that there is one investor, and in the time zero, you can say that the time zero, you can say that the initial investment, the initial time is the value of investment was 10,000 euros, and the rate of interest in the market was 8% per annum. And the interest income that the investor would be getting at the end of the period would be 800. As you can see, I just applied the simple Excel formula. Now there is a macroeconomic change in time one, which could be period one. The period could be 1 month or 1 year, okay? Because I'm calculating the interest rate in the annualized way. So let's say that in the year one, the interest rate has risen to 10%. Now, what happens to the investors' position? How the cash flow of investors are affected? Before this change, the investor was earning 800 interest income, 800 euros as interest income for the year. Now the rate of interest is 10%. In other words, in order to earn 800 euros of interest income now, all you need to do is to invest 8,000 euros. And how do I get it? I simply multiply cell I7 and divide by H7. And I wrote a note here that higher rate of interest rate leads to the lower value of investment. In other words, to earn the same amount of rate of interest which the investor was earning the previous year, you don't need to invest 10,000 euros. All you need to do is to invest 8,000 euros. In other words, the value of investment, which was 10,000 euros last year, has fallen to 8,000 euros. To make it more practical, if you have invested 10,000 euros in year zero, and now you are planning to sell this investment in the year one, you will not get more than 8,000 euros. In other words, your value has eroded from 10,000 euros to 8,000 euros. So if you sell it, you would be getting 2,000 euros of loss. So the capital gain would be the negative. In other words, you have the loss on the investment by 2,000 euros. So as you can see that there is an inverse relationship between the rate of interest and the value of the investment. So that is why that goes back to my point, which I was discussing on the slide, that because the interest rates have gone up in the EU zone, therefore, what has happened? The investors has been marooned heavily. They have lost lots of money. And when they are losing money, then obviously they are demoralized, they are disincentivized to make investment for the future. And similarly, I cooked up another hypothetical example that in case the interest rate falls again from 10% to 6%, then in order to earn 800 euros, the investor has to invest 13,333, okay? Which means that if you have invested in time zero, 10,000 euros, and at the end of year two, you find that the interest rate has gone down to 6%, then the value of the investment will increase. And now if you sell this investment, you would be getting a capital gain of 3,333 euros. So this is what the mechanism of the interest rates and the value of the investment is. Okay, we are back to the slide. The further interest rates are likely to go up. Um, this projection is that it basically implies that the credit supply, the money supply by the central banks is now more tightened. The central banks, the national central banks of the EU nations and the ECB, the European Central Bank, which is the apex bank, they are following very strict monetary policy. The supply of money is now less in the EU area, and the interest rates are more. And on top of that, the fiscal support, which the government used to provide, still providing, of course, but that the fiscal support has gone down. When I say fiscal support, it basically means that the state's action through the through the taxation, the public borrowing, and the public expenditure. So, in other words, in this current scenario, the state is taxing more, state is providing lesser subsidies, the state has actually curtailed its public expenditure, and the public borrowings are increasing so that the money is flowing from people to the central bank, so that there is less money supply in the economy, and as a result, the inflation, the interest rate has gone up, and because of the interest rate going up, the investors are finding it very hard to survive. Um, for this year, according to the European Central Bank, the the GDP forecast is only 1%. It was 3.6% in the last year, but it didn't achieve. Of course, it didn't achieve 3.6%. But for the current financial year, the GDP forecast is in 23 is 1%. But there are some positive signs as well, which could be, if not making us very euphoric, at least can make us some feel good factor that yeah, something good is also happening in the EU, and that is there are growing stocks and there's more certainty of the energy supplies, emitting some positive signs. In other words, the countries are now in a position to build up more inventory, and they have smoothened, more streamlined the supply chain of the energy and the other essential products, which means that there's a very high likelihood that inflation will not rise much when it comes to the energy products and the other essential products. So if the energy prices are not falling, which can be a dream, at least they would remain stable. And already, when you drive past the gas stations in many countries in the EU, you find that the prices are even marginally going down. Okay, even though that is very short term, the time is too short to make some conclusion. But yes, some positive vibes. You can see that there are prices even a little bit falling. Okay, the GDP projection for 24 and 25 is 1.6%. If the countries in the EU are able to achieve it, that would be a massive success. But now this forecast is based on some projections. Okay, it's not a fluke. It's not just something somebody decide to cook up the numbers. It means that the economists, the planners, they are pretty much realistic that EU, unless and until if something really bad happens, would be in a position to achieve 1.6% rate of growth, GDP growth, which would be a big, achievement. Many countries were not even achieving 1.6% growth in the GDP before COVID-19 period. So if they are able to achieve in 24 and 25, that would be a massive success. One more thing which is happening is that the euro is now, appreciating. In other words, the value of the euro in terms of some other hard currencies, the global currencies, is now increasing. Okay, and as a result, the import of essential goods from the other countries is now less expensive, because when the value of the domestic currency is increasing vis-a-vis the other currencies, it means that if you want to import something from abroad, you have to pay lesser units of the domestic currency. It means that the local inflation in the EU can be offset by the import from the other countries. Now, whether overall we achieve a positive, which means a favorable situation, or negative, or the unfavorable situation, it depends upon the difference between point one, this red background, and the green background, which is the positive sign. So let's see. We can't say anything yet, but I would say that even if the net remains negative, but the negative is lesser negative than the previous year in 22, I would say that in 23, the EU has achieved remarkable success. But we are only, we are almost touching the first half of 23. It depends upon what happens in the next half of this year. Okay, so at this moment, this semester, not semester, but this half year has been pretty good in terms of EU's economic progress, relatively, not in the absolute sense, but in the comparative sense. This first half of 23 has been way better than the last half of year 22. So let's see what happens in the remaining, the second half of 23. And here you can see the traditional pictures or diagrams that we often draw in the macroeconomics, and you can find them in any standard fundamental book of macroeconomics. You can see that on the leftmost side, there is a aggregate supply curve, and the aggregate demand curve is AD1. And when the demand increases and the supply remains constant, then what happens is that the prices increase. You can see that there is a price jump from P1 to P2, which is inflation, of course. But this inflation is relatively good or benign. I'm giving very big statement. This is a relatively good inflation. What is good about this inflation? The good thing about this inflation is that, first of all, let's see what is the bad thing about this inflation. Like any other inflation, like any other category of inflation, there is a price rise. That is a bad thing. But the good thing is that the output, the income of the people has jumped from OQ1 to OQ2, Q1 to Q2. At least people are getting income increase. At least people are getting jobs. Inflation is more, rents are high, utilities are getting more expensive, the food prices may increase, but at least people can do something. Maybe they can do part-time job, extra part-time job. Maybe they do 2 shifts. Maybe they increase their portfolio of income. But the best part is that the employment, the income, output, and employment is also increasing with this type of inflation. So on the one hand, there is a hole in the pocket with the price increase, but on the other hand, people are able to generate more income as well. Okay, so technically people are not unemployed. The prices are increasing in the market. The entrepreneur, the businesses, their profits are increasing. They want to sell more. Obviously, to sell more, they need to produce more. To produce more, they need more workers, and the workers get the job. Okay. Even though the living standards may go down, but it's not altogether decimation of their, the lifestyle. The problem is with the middle picture one, which is the cost push inflation. And by the way, it doesn't take too long before there's a transition from the demand pull inflation to the cost push inflation. The benign one is the demand pull inflation, because the prices are increasing more because of the increase in demand rather than the decrease in the the prices are increasing more because of the increase in demand and not because of decrease in the supply. But the problem is that the second picture is not showing anything. The middle picture is not showing anything about the increase in demand, but there is a decrease in the supply. You can see that the supply curve in the good time used to be AS1, but now the supply curve has shrunk, and it's now AS2, which basically means that on the one hand, there is an increase in the price from P1 to P2, but on the other hand, there is a fall in the income, output, and employment level in the country, in the economy. And as a result, not only people are paying more price, but people are also getting unemployed. And this whole idea is summarized in this rightmost curve. Um, okay. And here you can see that there is a stagflation. Stagflation is exactly the phenomenon. Stagflation is exactly the thing which we were discussing about, that there is a coexistence of unemployment and inflation. The traditional theory says that there is a trade-off between inflation and unemployment. In other words, the traditional theory says that if the country have more inflation, then it would have lesser unemployment, or if it wants to reduce the inflation, then it should be prepared to accept the higher percentage of unemployment. But the problem with the stagflation is that you have the worst of both worlds. You have inflation, and that also there is existence of unemployment. So the stagflation is a very diabolical situation when you have inflation and unemployment coexisting. And you can see here that when there's an arrow up, it shows, yeah. So it means that for the same amount of inflation, the unemployment increases, or for the same level of unemployment, the inflation increases. So in other words, there is rise in both inflation and unemployment. And I think the EU is actually experiencing exactly this situation because it was purely inflation, demand pull inflation, all right, then people should have been not becoming unemployed. But that we see that the inflation in the EU at the moment is not demand pull, it is cost push inflation. And as a result, there is a further increase in unemployment along with the further increase in inflation. I think I can explain this mechanism once again. Uh, Very often you see in the textbooks in the school level of the first year undergrad that this is the picture we very often see in the fundamentals of economics. This is demand curve, and this is a supply curve. And this exactly I've drawn here. The D1 is the demand curve, initial demand curve, and the S1 is the initial supply curve. And the equilibrium is taking place at E1, right? And there is O, I can say O with origin, OQ1, amount of output, income, employment in the economy. And then the price in the market is OP1 per unit, right? This is what it is to begin with. But there can be two types of disruptions. The one disruption is that the demand moves up, which means it becomes D2, D2. Supply remains S1, S1. The equilibrium is now at, this should be not E1, but E2. Yeah, so this is E2. There is a price OP star, which is higher than OP1. So this is inflation. But the benign part of this inflation is that the income, output, and employment has jumped from OQ1 to OQ2, which means there is an increase in the GDP of the country. But there can be one more. So this is the demand pull inflation, what I call as a benign inflation. But the inflation that we all despise more than any other inflation is the cost push inflation. The starting point is same. D1 is the original demand curve and S1 is the original supply curve. Equilibrium is the original equilibrium. OP1 is the original price, and OQ1 is the current level of income, employment, and income, output, employment, let's say GDP of the country. Now, what happened is that this time demand remains D1, D1, but supply curve shrinks to S2, S2, which means the supply curve is now smaller, right? It has decreased. The new equilibrium is E star here, and the price is OP star, which is higher than OP1. So this part, this P1 to P star is showing the inflation, but this inflation is not caused by the demand increase. This is caused by the output decrease. And you can see that at the new equilibrium, Thus, output, income, and employment is going down from OQ1 to OQ star. And now you see the difference. Inflation is same, P1 to P star. That is the inflation. That is the increase in the price. But in one instance, when the demand increases, when it's a demand pull inflation, there is a one good news that income, output, employment increases. But when the inflation, the same inflation P1 to P star, is caused by the decrease in supply, the cost push inflation, then there is a fall in the GDP of the country. Income, output, employment, they decrease. The first one is caused by demand increase because people have more disposable income, they want to spend it. The other one is caused by the cost increase. So this is a kind of the cost push inflation is very bad inflation, I would say, because here what happened is that the cost is increasing. When the wage are increasing, interests are increasing, the staff is getting more amount in terms of salary. So it's a demand pull inflation. But essentially the entrepreneur feels this heat and he or she start cutting down the employment, cutting down the activities. Okay, the inventories are full, so there is no need to produce more. And as a result, there is a retrenchment of labor. People get sacked. There's no further production, and the factories shut down. That is a thing which is really happening in the EU at the moment. So once again, I repeat, at the moment, inflation that we're experiencing in EU is not demand pull. I wish it was a demand pull if there was no choice, but unfortunately, it's a cost push inflation. The next characteristic that we see about the EU macroeconomic indicators is that the growth and inflation projection. And as you can see, and I told you before that the real GDP, the forecast is 1% for this year, 23, and 1.6 and 1.6 for 24 and 25. That is something which we need to keep. And you can see here that I added a few words here, the concept, because here the concept is real GDP, not the nominal GDP. The real GDP is the GDP which is adjusted for the inflation rate. So in other words, if the nominal GDP, which is measured by multiplying the current output with the current prices, but the problem is that the real GDP can go up not because of more output, but because of the more prices. Therefore, the nominal GDP can be misleading sometimes. So to overcome this limitation, we prefer researchers, the policymakers, and all the stakeholders. They generally prefer to have the real GDP, which is nominal GDP, which is current output multiplied by the current prices. So you take away, you subtract the inflation rate. That is the real or more credible indicator of the GDP growth of the economy. So in other words, if the nominal GDP is increasing at 4% a year, but the inflation rate in the country is 5%, then 4 minus 5% basically means that the country's real GDP is shrinking by 1%. Okay? And similarly, I wanted to clarify the theoretical part that inflation to call, look, every inflation is characterized by the price increase. So whenever there is inflation, the price will go up. But every price increase cannot be called as inflation. To call it inflation, the price should be not restricted to one or two products, but there should be a general price increase. And it should be substantial. It should be quite big enough to call it inflation. It should be continuous, not coming and going, coming and no. There should be a consecutive increase, continuous increase in the price. And then the time period of increase in price cannot be 1 day, 1 week, but it should be a fairly longer period of time. Okay, so you can see that in the forecast, which has been made in March 23, the real GDP is looking very promising for 24 and 25. And I think we had discussion about it before as well. Since I used the two phrases, the nominal GDP and the real GDP, so I thought that I should give you some more insight into these two concepts. So here I just took the imaginary data, and you can see that I took 5 years from 2020 to 24. I included next year also. And these are the current prices per unit each year. So there is an average price, 4, 5, 6, 15, and 27 euros per unit of the output, the average price, like we calculate the consumer price index in the country. The output is given here. And when we calculate, and these are the constant prices, which means that we take one base year, because the prices could be changing, could be increasing over time. So to overcome the impact of the price increase in the calculation of the GDP, and then making some wrong interpretation, what we do is that we take the output of the current year, but for the price calculation, we take one base year. And here you can see that we have taken the base year of the base year price is of 2020, and you can see that all the years the base year price remains same. Generally, it happened in many countries that you take the beginning of the decade as a base year price, and then you calculate, you continue with that base year for the rest of the decade. And then the next decade come, and the first year of the decade is taken as a base year price, so that you can have a comparison of GDP over a decade, the real GDP comparison, so that you're not mistaken, you're not actually confused by the price, the inflationary impact taking place on a yearly basis. So this is a very good methodology. So what we do here is that, first of all, we calculate the nominal GDP, which is the current price multiplied by the current output. For instance, you can see here that I just multiply the corresponding cells in each row, the output multiplied by the current prices. And you can see that there's a big jump from 84 to 150 in 23 when compared with 22. But when I see the output has gone down in 23. But when I see the nominal GDP, there's nearly 50%, not even 50%, there is almost 80% increase in the nominal GDP. So how is it possible that your GDP is increasing when your total output, the real output, the material output, the output and the services produced in the factories by different commercial organizations, that output has fallen, but your nominal GDP is increasing? It is because the nominal GDP has increased because of the increase in the prices, even though the output in the country is going down. Therefore, this can be misleading. To overcome this limitation, what we do, we calculate the real GDP, which is equal to the current output multiplied by the constant prices. So we take 4, the constant price throughout. And then when we draw this data, when we draw the picture, we find that we take GDP on the vertical axis and the years on the horizontal axis. And you can see that the nominal GDP is going up, whereas the real GDP is either constant, there's a minor increase, and then there is a decrease in the real GDP, which is more realistic situation. When you compare this yellow line, it fully corresponds with the output of the units of output in the country. So therefore, my suggestion to the students is that whenever you want to see you want to make a comparison of an economy based on the GDP, nominal GDP is important, of course, because you have to have the records of each year's calculation. But when you want to make the comparison that whether there is an increase or decrease in economic growth, I would recommend that you should look at the GDP growth rate, but of real GDP growth rate, but not the nominal GDP growth rate. That can be misleading because of there is an intrusion of the inflationary impact in the nominal GDP. So the best measure, not the best measure, but one of the best measures to compare the economic growth is the real GDP growth rate. And then we quickly move on to the interest rates, and you can see that the Euribor rate, the 3-month Euribor rate, which in 22 was 0.3%, in 23 is 3.3%. And what is the Euribor rate? The Euribor rate is the average, is a daily average interest rates which the collection of the top banks in the EU would charge from a company which is having a triple A rating, A triple plus or AAA, the triple A rating, which means that this is the rate of interest which the bank would charge from the company with zero risk potential. And as the companies, in the real life, not all the companies are zero risk. As the company's risk profile goes up, then the risk premium, which is added to the interest rate, is also increased. So in other words, if the company is AAA, then the interest rate that the company would pay to the bank is 3.3%. But if the company is not the best company in terms of risk, the company is risky, it's not AAA, but let's say it's AAB. Then on top of this base rate, 3.3%, maybe the bank charge 1% more rate of interest. And then the interest rate this AAB company pays will be 4.3, not 3.3. Even though the base rate is 3.3%, but the bank would charge risk premium 1%. And as this AAB becomes ABB, I'm just making a hypothetical situation, then the bank would charge not 1% risk premium, but maybe 5% risk premium. So in that case, this ABB company will not pay 3.3%, but it would pay 8.3%, which is 3.3 plus 5%, the risk premium. So as the companies becoming more and more risky, the risk premium that they pay on top of the base rate is also increasing. And the 3.3 is the Euribor rate, is the base rate. And you can see that it used to be 0.3%. And now it's 3.3. So even though the company's risk profile remains same, even the most riskless company in Europe is paying more interest than before because the Euribor has increased. Euribor is the base rate which the company would pay anyways, right? So even though the risk premium and situation becomes even more cumbersome, even more mind-boggling when the base rate is increasing and the risk profile of the company is increasing. So, see, it's hard to imagine that the companies in EU, their risk profile remains same. I mean, COVID-19, the Russia-Ukraine war, the supply chain is totally disrupted. How is it possible that the company's riskiness has not increased? So it's like a two-edged sword. On the one hand, the base rate has increased, and then the risk premium that the companies are paying now is like is a massive rate of interest they pay. So that is why it's very important to see that the interest rates has increased, and the companies, the banks in the EU are following very rigid, very strict monetary policy, and honestly, it's not going to change in the near future. There might be changes, but not substantial changes, what we forecast. But it will take a couple of years when things may come down to the normal, maybe more years, I would say, even 2 or 3 years are not enough. Yeah. Sorry, I just cancel it. The last but not the least important macroeconomic factor, which I would like to share with you, is that that the euro is getting stronger in terms of American dollar. You can see that you can see that for the second half of the 22, there has been a very perceptible decline in the value of the euro, 1 euro measured by a number of US dollars. But you can see that in the beginning of 23, the value of euro in terms of American dollars is increasing. So the overall trend has been, so it's like a V shape, which means that in the second half of 22, euro has lost considerable value against American dollar. But in the beginning, since the beginning of this new year in 23, there is an increase in the value of the euro. So you can see that you have to pay more USD to get 1 euro. Situation is not very different. If you look at the overall trend, there are some heads and shoulders you can see here. But if I have to draw a straight line for this period, I would say that despite this recent month's decline in the value of euro vis-a-vis Great Britain pound, the trend has been quite upwards. Means that except for the last month, there has been, despite these movement on top of the line and the below the line, so the overall trajectory of this trend has been upward sloping. Okay, of course there has been decline in the value of euro in terms of GBP, but there have been big, the spikes as well. So the overall average trend has been that the value of the euro in terms of GBP has been increasing, except for the month of May, which basically means that if you look at the movement of euro vis-a-vis US dollar, and if you see the movement of EU vis-a-vis GBP, except for the last month, it basically means that euro is getting stronger against the two other global currencies, that is the USD and the pound sterling, which basically means that despite there is a possibility that the domestic decline or the lack of supply of the essential goods, it can be met by the imports because of the rising value of euro against USD and the Great Britain pound. And I just took some of these clippings from different popular media, from Wall Street Journal, from BBC, from Guardian, and all the concepts that basically that we have used in this lesson, they all have been appeared as headlines. So in other words, all the theories, because the basic idea of this topic was that I wanted to highlight the current macroeconomic scenario of EU, but I also wanted to bring in those key theoretical concepts which we read in the books and we assume that they are never used in the reality. But I try to explain the macroeconomic fundamentals of EU in terms of some conceptual things. And I'm not the only one who is using these conceptual things. You can see the headlines of these media, I took some the titles published in different journals, in different newspapers, in different, even the IMF. So what I'm trying to say is that these concepts, these fundamentals, theoretical fundamentals, they are also in the practice. And I'm not the only one who's using it. BBC is using it. Wall Street Journal is using it. The Guardian is using it, right? The IMF people are using it, okay? So this is why it's very important to understand not only a phenomena, but it's even more important to understand the phenomena in terms of some established theoretical paradigms. Thank you very much, and please give your feedback about this lesson to me. Thank you so much. Good luck.